Welcome back to the Deep Dive. We're really glad you could join us today. This is the show for you, the curious listener, where we try to break down some pretty complex stuff happening in the world.
We really try to pull out the essentials, make it make sense.
Exactly. We know you want to stay informed, but let's be honest, it can get overwhelming out there. So thanks for letting us into your ears today.
Yeah, thanks for tuning in. So today, we're diving into something that's, well, it's changing how basically everyone deals with money. It's called embedded finance.
Embedded finance?
Yeah.
Okay, so what is that exactly?
Think of it like this. It's when financial services like loans, insurance, maybe credit, get built right into apps and websites that aren't, traditional banks.
Ah, okay. So it's kind of like invisible money. Seamless.
That's a great way to put it. Seamless, invisible money. And it's not just some niche thing. It's huge.
Right. The numbers are pretty wild. Our research shows just in the Asia-Pacific region, they're expecting revenues from this stuff to hit, US $360 billion by 2029.
Yeah, with a growth rate, a JRGR of like 24.4%. That's massive growth. The financial world is definitely all in on this.
But that's where it gets tricky, isn't it? That's the big question we want to tackle today.
Exactly. There's this paradox. On one hand, it promises to empower people,
Yeah.
give them access to credit maybe they couldn't get before, but does this super smooth, frictionless experience actually end up exploiting our, psychological weak spots?
Pushing people, maybe small business owners too, into debt traps, all for profit.
That's the core tension. We really need to unpack what happens psychologically, systemically, when money decisions become almost inevitable. What's the real cost of making spending so easy?
It sounds almost trivial, like just moving the payment button a tiny bit closer to the buy button.
But the cognitive impact, it's huge. It really changes how we think, or rather don't think, about spending.
Okay, let's unpack this. So before we get into the dangers, we probably need to appreciate why embedded finance, or MFI, is so appealing in the first place. It is kind of genius in a way.
Oh, absolutely. The concept is revolutionary because it meets you right where you are. You're in an app, you need something financial, and boom, there it is. No need to go somewhere else, fill out another form.
Right. So you're shopping for clothes online, and the buy now, pay later option is just right there at checkout, not some separate website you have to click away to.
Exactly. Or you're on an education platform learning a new skill, and they offer payment plans for the course tuition right on the dashboard. It just smooths everything out.
And it's not just for us consumers, is it? It's happening everywhere.
Everywhere. Your phone company might offer a co-branded credit card or let you pay off that new phone in installments built right into your bill. We see it in business to business too, ordering heavy equipment, and the financing options are just part of the checkout process in the supplier's app.
So for the businesses offering this, the logic is pretty clear, I guess.
Oh yeah, it's a no-brainer for them. First, it makes their main product or service better, more convenient, makes you stick around, use their platform more. And second, crucially, it opens up totally new ways to make money, often high-margin revenue streams that might have nothing to do with what they originally sold you.
Okay, so speed, convenience, new revenue.
Yeah.
But let's get back to the psychology.
Yeah.
You mentioned removing friction. What does that actually do to our brains?
Well, when you remove friction, you basically remove what behavioral economists call the pain of paying. Think about the old ways, right? Counting out cash or even typing in your credit card number, the CVC code.
Yeah, those little pauses.
Those little pauses, exactly. They engage what Daniel Kahneman calls System 2 thinking, your slow, rational, deliberate brain. There's a moment, even a tiny one, where you consciously think, am I spending money? Is this worth it?
Right. System 2 is the brakes, the part that asks, hang on, do I really need this? Can I afford it?
Precisely. MFI, though, it's often designed to bypass System 2 entirely. It appeals straight to System 1, the fast, emotional, impulsive part of your brain.
The gut reaction part.
Yeah. Single-click payments, instant loan approvals, spending stops feeling like losing money. It just feels like getting the thing you want.
Yeah.
Or accessing the service. Your brain registers the convenience, not the cost.
That sounds potentially dangerous for everyday spending, but that same speed, it can be a good thing too, right? Especially for small businesses.
That's the other side of the coin, definitely. There's huge potential, particularly for what our sources call small giants, micro-retailers, especially in, say, developing economies.
You mean like the little corner shops, the local stores?
Exactly. These businesses are vital, but they often live and die by cash flow. Traditionally, if they needed inventory, they had to rely on informal credit, maybe family, maybe. Local moneylenders charging crazy interest rates.
Yeah, the loan sharks. Very expensive, very inflexible.
Right. So picture that shopkeeper in Jakarta we talked about. Needs stock for a big holiday, but they're short on cash.
Yeah.
A bank loan. Slow. Tons of paperwork. Maybe they don't even qualify. They need the money now. So with MFi, the app they already use to order inventory from their supplier can offer them buy now, pay later, tailored specifically to their business cycle. The platform already knows their sales, their needs.
Because they have the data.
They have the data,
Mm-hmm.
so they can offer funding way faster and potentially cheaper than any traditional lender could.
And the numbers on cost reduction are pretty impressive.
They really are. Embedded finance, done right, could cut the cost of credit for these small shops by like 20% to 60%, and maybe even reduce their supply costs by 10% to 30% through better logistics on the platform. It's using data for genuine, affordable inclusion.
So the same speed that taps into a consumer's impulsivity can actually be a lifeline for a small business. It's fascinating how it cuts both ways.
Absolutely. That removal of friction.
Yeah.
It's the key that unlocks both the opportunity and, well, the potential for exploitation.
Which leads us right into that darker side, the design itself. This is where it gets really interesting and maybe a bit scary. You mentioned dark patterns.
Yeah, dark patterns. It's a term for user interface designs that are, frankly, engineered to trick you, to nudge you into doing things you probably wouldn't choose if you were thinking clearly. They leverage those System 1 impulses we talked about.
And in finance, that means?
It can mean pushing you towards, say, a really high-interest loan option, or maybe automatically signing you up for recurring fees or insurance you didn't really want.
Can you give some examples? How do these actually look on an app?
Sure. One common one is called misdirection. This is where, the button to accept something potentially bad for you, like costly overdraft protection, is big and bright green, while the button to decline is tiny, grayed out, hidden somewhere else.
Designed to make you just click the easy option without thinking?
Exactly. Especially if you're on your phone, moving fast. Then there's confirm shaming.
And firm shaming.
Yeah, it's where declining an offer is framed to make you feel stupid or irresponsible. Like if you say no to that overdraft service, the pop-up might say, "No thanks, I enjoy paying huge penalty fees." It uses guilt or fear.
Wow. That's quite manipulative.
It is. And another one, super relevant to MFi, is privacy zuckering, named after,
I think we can guess.
Right. Since MFi relies so heavily on your data, where you shop, who you know, what you buy, platforms have a huge incentive to get you to share more than you realize. Vague permissions, confusing opt-outs. They build this detailed financial profile on you.
Which they can then use to target you with offers designed to exploit your specific spending habits or vulnerabilities.
Precisely. And this isn't theoretical. Big companies have been caught doing this.
Like the Intuit TurboTax case?
That's a perfect example. The FTC went after them for deceptive advertising. They were basically using a classic bait and switch. They advertised free tax filing really heavily. But for many people, especially gig workers or anyone with slightly more complex taxes, it turned out they weren't eligible for the free version after they'd already entered all their sensitive financial data.
So you've already invested the time and effort.
Exactly. The sunk cost fallacy kicks in. You think, I've already done all this work. I don't want to start over somewhere else.
Yeah.
So you just pay. It was deceptive, and it cost them, what was it, a $141 million settlement. Shows regulators are noticing these patterns.
Okay, so the design can trick you, but what about the actual cost of the credit itself? We use the term predatory inclusion. That sounds ominous.
It is. Because access to finance sounds good, right? Inclusion. But what if the terms of that access are designed to cripple you financially?
That's where the Kenya example comes in.
Yeah, the Kenyan digital lending story is a really stark warning. Initially, everyone was excited, mobile loans, FinTech revolution. But by 2019, the reality was, well, devastating. Huge debt burdens, collectors using really aggressive tactics, misuse of people's data.
And the cost of these instant short-term loans, you shared some numbers that were just mind-blowing.
They are shocking. Median effective APR, the typical cost was 96.5%, which is already incredibly high.
96%, okay.
But the average pulled up by the most expensive loans was 280.5%.
Wait, say that again?
280.5% effective APR.
That's not just high interest. That's basically legalized loan sharking through an app. What on earth were people using this money for? Growth? Investment?
Sadly, no. The data showed overwhelmingly it was for basic needs. Food, paying utility bills, covering household expenses, not starting a business, not investing in something productive.
So people were effectively paying a nearly 300% interest rate just to survive, just to buy groceries.
That's exactly what it means. It's adding an enormous surcharge onto the very act of being poor. It guarantees you'll be trapped in debt.
And if you couldn't pay it back.
Default meant getting blacklisted by credit bureaus.
Yeah.
In 2017 alone, there were over 2.7 million negative listings just from these mobile loans. And that blacklisting doesn't just block you from future loans. It can stop you getting a job, finding housing. It pushes people further into the margins.
It's a downward spiral, fueled by supposed inclusion. And this isn't just limited to places like Kenya, right? Developed economies have their own versions. Like Brazil.
Brazil's a really interesting case because they have high financial inclusion, lots of people have bank accounts and cards. But credit card debt is massive. In March 2024, it was almost 87% of all household debt.
Wow.
And the danger there is the culture of installments. It's so easy to buy something now and pay it off over 6, 12, even 24 months.
Seems convenient up front.
Super convenient. But the interest rates hidden in those installments can be crushing. People get used to carrying this rolling balance, constantly juggling payments. It becomes this double burden of debt, hitting lower-income families hardest.
And the idea that financial education is the fix.
It's just not enough. Not when the crucial information in the real APR, the total cost, the fees, is deliberately buried in tiny print, using super technical jargon that almost no one understands. The system is often designed to obscure the true cost.
Okay, so we have manipulative designs and crippling costs. But then there's the whole layer of algorithms and AI making the lending decisions. That brings in another level of unfairness, doesn't it?
Absolutely. This connects directly back to those hidden costs and structural issues. There's this persistent myth that algorithms are neutral, that because a computer's making the decision, it must be objective.
Yeah, people think code is unbiased.
But it's not. And AI is trained on data. And if that historical data reflects decades, even centuries, of racial bias, gender bias, economic inequality, the AI doesn't magically become fair. It just learns to replicate those same biases.
So it digitizes discrimination.
Precisely. It becomes what we call proxy discrimination. The algorithm might not explicitly use race or gender that's illegal, but it finds other data points that correlate strongly with those things.
Like what kind of data points?
It could be your zip code, maybe the types of shops you frequent, your social media connections, how often you overdraft. Seemingly neutral things that, when combined, act as a proxy for race or wealth or gender identity.
Allowing lenders to discriminate without technically discriminating.
Exactly. It makes these existing inequalities stickier, harder to root out, because it's hidden inside the black box of the algorithm.
And the real-world impact on individuals can be devastating. You shared a particularly powerful anecdote about transgender people interacting with the credit system.
Yes, that really highlights the cruelty of rigid data systems. When a trans person transitions and legally changes their name, their old name, their dead name, often stays linked to their credit file. The systems just aren't built for that kind of change.
So every time they apply for a loan, a job, an apartment,
their credit report effectively outs them. It reveals their transgender status without their consent. It's a profound violation of privacy.
That's awful. And what's the financial consequence?
To avoid being constantly outed, some people feel they have no choice but to try and build a completely new financial identity under their affirmed name. But that means starting from scratch. Their entire credit history is wiped out.
Making them look like a high-risk borrower.
Instantly. No history means higher interest rates, lower loan amounts, maybe outright denial of credit. It penalizes them financially for protecting their basic privacy and identity.
And we see similar penalties along racial lines too, right? Based on historical wealth gaps in the U.S.
Definitely. The data is stark. White Americans, on average, have far more generational wealth than Black Americans. This historical disadvantage translates directly into things like lower average credit scores and thinner credit files for Black and Latino customers.
So even when the algorithm approves them, they pay more.
Often, yes. They're perceived as higher risk, partly because the algorithms are trained on data reflecting that historical inequality, so they face higher interest rates.
And this isn't just marginal amounts, is it?
No, it adds up significantly. One major study found that Latino and African American borrowers pay around $765 million more each year in mortgage interest alone, just because of this kind of discrimination baked into the system. The algorithm isn't just assessing risk, it's actively costing marginalized communities more money.
So if these systems rely on all this sensitive personal data to fuel potentially biased algorithms, that raises another huge red flag: data security.
Absolutely. MFI fundamentally changes the security landscape. Traditional banks, for all their faults, are heavily regulated and tend to invest heavily in security.
They have to.
They have to. But when your loan comes via, say, your favorite clothing retailer's app, that retailer might not have the same security standards. For them, robust security is often seen just as a cost, not a core part of their business like it is for a bank.
So the whole system is only as secure as its weakest link.
Pretty much.
Mm-hmm.
And the data shows this risk. A 2024 study found 15% of data breaches started with a third-party vendor like that retailer partner. That was up 68% from the year before.
Wow.
Plus, MFI relies on tons of these connections between different companies' APIs, they're called. Every connection point is another potential vulnerability, another place for hackers to try and break in. It just expands the attack surface, as they say in cybersecurity. Identity theft attempts jumped 40% in 2024, partly because of this expanding network.
And quickly, let's touch on gender bias again. You mentioned that digital credit in Kenya actually widened the gap initially. How did that happen?
Yeah, it's counterintuitive, isn't it? But some early products, like M-Shwari, were designed in ways that implicitly favored borrowing patterns more common among men, like having a single, stable, full-time job.
Okay.
Whereas women entrepreneurs often run smaller, maybe part-time or seasonal businesses with more irregular income. The algorithms just weren't designed to properly value that kind of economic activity. So women were either excluded or offered worse terms, reinforcing existing inequalities instead of closing the gap.
Okay, so what we're seeing is a system that's incredibly fast, plays on our psychology, runs on potentially biased data, increases security risks, and the regulators are struggling to keep up.
That's the crux of it: regulatory lag. The traditional way of making rules carefully defining every little detail is just too slow for the pace of FinTech innovation. A company can launch a new M5 product globally before the regulators in one country have even finished drafting the rules for the last product.
And you mentioned the U.S. system is particularly complex.
It's incredibly fragmented. You've got federal agencies like the CFPB, HUD, then you've got 50 different sets of state laws and regulators. Trying to create consistent oversight is a massive challenge. The rules themselves are often based on laws written decades ago before any of this technology existed.
And how does that compare to somewhere like Canada?
Well, the U.S. regulators, especially the CSPB, have at least started talking openly about algorithmic bias and using tools like disparate impact analysis, looking at whether a neutral-seeming practice still harms certain groups disproportionately. Our sources suggest Canadian regulators are maybe a bit earlier in that process, not yet grappling with potential discrimination in algorithms quite as directly.
So if just giving access can lead to these 280% APR loans and debt traps, then financial inclusion isn't really the right goal anymore, is it? You mentioned something called productive inclusion.
Exactly. Productive inclusion shifts the focus. It's not just about can someone get credit, but do the terms of that credit actually help them? Does it contribute to their economic well-being, help them build assets, smooth income, or does it just mire them in unsustainable debt? The goal has to be empowerment, not extraction.
So how do we get there? What kinds of solutions or frameworks could actually push the industry towards that?
Well, there are several ideas being floated. One key piece of legislation proposed in the U.S. is the Algorithmic Accountability Act.
What would that do?
Essentially, it would require larger companies using AI for important decisions like lending to regularly test their algorithms for bias and discrimination. It puts the burden on them to prove their systems are fair rather than on the consumer to prove they were harmed.
That seems like a major shift, making them look for problems proactively.
It is. Another idea is using technology for transparency by design. Imagine something like an interactive credit simulator may choose your own adventure for your finances.
How would that work?
You could play around, see, okay, if I take this type of loan, or if I miss a payment here, how does that actually affect my score, my total debt? It helps people understand the real impact of different choices and acts as a check on those hidden algorithmic biases.
Makes the black box a little less opaque. And what about stopping those incredibly high interest rates, like in the Kenya example?
That really requires direct government intervention. Things like setting clear interest rate caps or ceilings, especially for loans aimed at vulnerable populations, and enforcing clarity in communication.
Like that South African law you mentioned.
Exactly. South Africa's National Credit Act, updated for 2025, mandates using plain language. No more hiding behind dense legal jargon and tiny print. Costs have to be clear. And things like ensuring people get refunds if they repay a loan early, that was a big issue in Kenya.
These all target the financial products themselves. But you hinted earlier that maybe the root cause of needing these high-cost loans isn't purely financial.
Yeah, that really raises a fundamental question, doesn't it? When you see people taking out 280% APR loans just to buy food or pay rent, that's not just a failure of the financial product. It's often a signal of a deeper failure in the social safety net.
People are borrowing because they don't have other options, because basic necessities are unaffordable or incomes are too low and unstable.
Precisely. The demand for predatory credit is often created by poverty, by the rising costs of housing, healthcare, education. So while regulating MFI is crucial, the ultimate solution might lie partly outside finance.
In stronger social support systems?
Potentially, yes. And within finance, it means shifting the business models, moving away from relying on short-term, high-interest loans that punish unstable incomes and towards more patient capital. Financial products designed to actually accommodate low and irregular incomes, to provide a real bridge to stability, not just a quick fix that leads to deeper debt. That's the real challenge. #outro.
So, wrapping this up, what have we learned? Embedded finance, this seamless money, has incredible potential, doesn't it? It can offer speed and access in ways traditional banking never could.
Absolutely. But right now, it feels like that potential is often being exploited. The very convenience is used through dark patterns and biased algorithms to push people into costly debt traps. It's benefiting the predators, perhaps more than the people it claims to serve.
The path forward seems to require a big shift then, from just providing access to ensuring that access is genuinely productive, genuinely fair.
Yeah, we need regulators who can keep up, who demand accountability from algorithms, demand transparency in design, and ensure that credit actually helps people get ahead, rather than just adding this huge extra cost to basic survival.
We live in a world now where convenience is constantly being monetized, and our data is the currency. So, thinking about everything we've discussed, now that you know a bit more about how this seamless world tracks and potentially targets your financial behavior, maybe ask yourself, what's the first bit of fine print, the first automatic renewal or bundled fee that you're going to look for and really read next time before you just click, I agree?
And we genuinely want to hear from you, our listeners.
Yeah.
Have you ever been caught out by one of these dark patterns, maybe enrolled in something you didn't realize? Have you used BNPL or another embedded loan? What was your experience? How did you figure out the true cost?
Please share your stories, your insights. How do you navigate these integrated financial products? Your experiences are so valuable for understanding how this all plays out in the real world, and it helps all of us in this community learn together.
Yeah, your input really matters.
Thank you so much for joining us today, for digging into this really complex and important topic with us. We appreciate you lending us your time.
We'll catch you next time on The Deep Dive.